Welcome back. Not only is China dealing with that drought, the country's currency is losing some strength against the US dollar. This as worries of a slowing economy continue to weigh down sentiment. As global commodities are feeling the brunt of these concerns, our next guest is seeing this pressure across the board, especially in the metals sector. For more, let's bring in Bill Baruch. He's the president of Blue Line Futures, and he joins us now. I guess break it all down for us here, Bill. How is this all affecting metals?
Well, if you have the Chinese yuan losing value against the US dollar, and we're looking at metals being priced in dollars, that's a direct impact right there. But then you got to ask yourself, why is the Chinese yuan losing value against the dollar? And it's because there's a lack of economic activity. And if you look back at 2 weeks ago, there was new loan activity came in much lower than expected, something like 679 billion yuan. Relative to a 1.1 trillion yuan expectation. So almost half as much activity there. And then the following that on the Sunday night, last Sunday, there was just a really poor slate of economic data, fixed asset investment, industrial production, and all of these are indicators that China is slowing down. Goldman Sachs came on the heels of that and reduced their GDP estimates for China as well. But ultimately, they've cut their loan prime rate. They cut 2 benchmarks last week, and then they cut the loan prime rate 5 basis points for the 1-year rate last night. And 15 basis points for the 5-year rate last night. But the expectations were for a little bit of a larger cut. So it's going muted again in the market. On top of that, if no one wants to borrow and no one wants to lend, it really doesn't matter what the rates are at. So that's something to consider too. So the economic activity is just a really sour mood around that in China. And a lot has to do with the zero COVID policy.
We were just talking to the last guest about the drought China's also facing. Are there more headwinds still expected when we think about China's overall economy?
Yeah, there are more headwinds, but the markets are very efficient in the manner of pricing in macro news, and I think they've begun pricing that in already. Now the problem is there are technical tailwinds on this technical breakout in the U.S. dollar strength against the Chinese yuan, and that's something that could continue here for a little bit. So you have the sort of the macro effects have been priced in and taken the market to this technical breakout, and I got technical tailwinds. So if the U.S. dollar continues to strengthen against the yuan, now you're also here today, shifting gears, looking at Europe. The euro is well decisively below par against the U.S. dollar here today. So this is a broad strength in the U.S. dollar against other global currencies, and that's pressuring risk assets.
Well, you shifted there for me. I did want to turn to Europe next, where obviously energy prices have been a topic today. What's driving up those prices?
You're seeing oil being cut off from Russia. You're seeing a continued less activity through the pipelines for the gas pipelines. This is acting on something about 20% of what they were a year ago, and being able to stockpile for the winter is making it a very dicey situation, and that right there is driving up prices as they try to plan to stockpile, and we're starting to get some of the feared winter effects already.
Yeah, fear of winter. And of course, Germany's Chancellor Olaf Scholz is visiting Canada right now, looking for some of those solutions to Germany's energy crisis. Do you think there's going to be any way that Canada is going to be able to help in much of a way that will do anything?
Well, listen, they're trying to stick a Band-Aid over a big flesh wound that began years ago, and it's the underinvestment and their own power. I mean, they set themselves. They made this bet years ago. They ignored calls for investment and expanding, whether it be nuclear capacity, coal capacity, something, and building out pipelines and other relationships. And they relied on Russia. This is something that's been years in the making, and it's not going to turn very quickly. But I would imagine that the situation is going to improve over the next 12 to 18 months. Right now it's making towards a like I said, very dicey situation this winter.
Yeah, and I guess it really depends on how bad this winter actually gets in Europe as well. And of course, we need to talk about oil. There's so much going on right now. But what do you expect from that Iran nuclear deal that we are hearing from Iran is being delayed, procrastinated on?
Yeah, we've seen a big whipsaw here today. There was some talks coming up the early this morning, some notes saying that there could be a deal imminent, and then you also heard some comments from Iran over the weekend saying that the U.S. is slowing a potential deal. Then what really drove oil lower, I believe, this morning really wasn't a news event so much, but it was the fact that Iran is saying they can boost their oil output in the wake of a deal. They're preparing for that. And I also think crude oil just kind of failed at the 21-day moving average again this morning. It's been struggling at that for a couple months now. But if you look at the market now, you're seeing what is, before I started here, a steady rebound. And that's on comments out of OPEC that because of the disconnection in the futures and the physical market, that they may have to reduce their output. Essentially, you're seeing the U.S. unload its strategic reserves in order to suppress prices. At the same time, you're seeing OPEC, they're trying to ramp up production, although they're still at 500% over compliance. Some 2 million plus barrels below where they should be, and some data that showed this morning. And they're stretched. They're stretched at their capacity right now. And so if the market has this disconnect, they're thinking, or they're telegraphing here that they could pull back output, and that's driving prices back up a little bit. So there are a number of disconnects in the market, and it's no surprise if you look at the landscape, there'd be a currency impact or war impact or just underinvestment.